All right, so today we're going to dive into the wonderful world of income taxes. And this is another one of those, who cares? What's the point? How does this affect me? Well, initially, you will be making money soon. And whenever you make any kind of money, the government wants to tax you on that. And whether you're earning that money as an employee or you're making it through, say, a hobby, if you do not properly report taxes, couple of things can happen. First of all, you may be denying yourself a refund, which is an easy way to get money back from the government. But also you may be putting yourself in danger if you're making income that is not being reported, and it's eventually could very well catch up to you. So this is an area where thousands and thousands of dollars can be affected by what you do and how you report what's going on with your income. First of all, I want to share what I think is a rather humorous video. It's on Facebook a couple years ago. Here you go.
Oh my gosh.
Where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses.
Bug, it's okay. It's part of the game.
No, it's not.
It's not
fun.
It's not fun to what?
It's the worst part of the game.
Is what?
Taxes.
Poor kid. He's been deeply affected by taxes. Anyway, there you go. It's the worst part of the game, taxes. We all feel that way. First of all, a couple of terms just to kind of get you warmed up to the idea of taxes, because you've heard of it before. Because first of all, we have like property tax, where like our high school and elementary school were funded through people having to pay a little bit extra based on the valuation of their property here in College Place. That's something you pay on an annual basis to the local county where you live. Property tax. Sales tax, which can get kind of confusing because people get confused with sales tax and income tax and all that. Well, sales tax is obviously a tax you pay at the time you buy something, like at Walmart, for 8.9% that they add to your amount billed. And then when you get to the cash register, you have to pay that extra. And that money goes in a whole bunch of different places, which I could maybe explain in detail later. But most of it goes to the state. About 6.5% of it goes to the state, and the rest of it goes to the local community to support a variety of programs. That's sales tax. And yet if you go across the border into Oregon, you pay zero. Okay? Income tax, usually in two forms. Income tax is either federal, United States, which everyone has to fill out that makes money, or has some sort of a return or something they have to report. Everyone has to fill out an income tax form for federal income tax. And then you have state income tax, which is very similar. You also have to fill out a form for that. But here in Washington State, knock on wood, we don't have this yet. We do not have a state income tax. A state like Oregon does. All right. So we have a higher sales tax here in Washington, but no income tax. Oregon, their property taxes are a little higher. They have no sales tax. They do have a state income tax. Right on? Taxable income is that money you make either from earnings or from other activities like bank interest or unemployment or some sort of a business that you have. Taxable means you're going to pay some sort of tax or amount to the government for whatever you're making. And again, that is called a tax. And those tax monies are used to fund a variety of things, but mainly just to support, the government and operating the government and your community and highways and all kinds of stuff. Education, of course, is a big one, a big draw where money is going to support those programs. Internal Revenue Service, the IRS, they are the governing body of the government who collects the tax from not only individuals, but also businesses, because there's a business income tax as well. There's different types of filing statuses. Most people are, especially you starting out here, you're single. You don't have any dependents. Nobody's depending on your income. You're not married. You're single. So that's one filing status. There's married filing jointly, where you're filing with a spouse or significant other. Again, that's a legal situation recognized by whatever entity you're in that allows you to do that. Some couples actually file single if they both make a lot of money, and we're going to look into that later. There's a qualifying widower where you lose your spouse, your spouse passes away in the year you're filing for. So it's almost like you're filing as married filing jointly. There's married filing separately, which I just mentioned before, is kind of the same as both parties filing as single. Then you have head of household. We have somebody that's single, but they have some sort of a person dependent upon their income, whether that is a child or even a parent can be a dependent of their child because maybe they're older and they're living in their house, and that child of theirs is now making money and supporting them. So again, head of household kind of gets some of the benefits of married filing jointly. They pay a little bit less in tax. Again, we're going to look at tax tables in relation to some of those things. We'll do a lot of practice here as we move forward. So I wanted to show this video about these three brothers. One moment.
So it's 10:30 on a Wednesday, and apparently I've sold close to $3,000 in sales on Amazon already.
Once upon a time, there were three brothers, triplets, named Tom, Dick, and Harry Class. They were raised in the same home with the same parents, had the same IQ, same skills, and same opportunities. Each was married and had 2 children. They were all carpenters making $25 per hour. While they were very similar in all these respects, they had different priorities. For example, Tom chose to work 20 hours per week, while his brother Dick worked 40 hours, and Harry 60. It should also be noted that Harry's wife worked full-time as an office manager for a salary of $50,000. Dick's wife sold real estate part-time 10 hours a week and made $25,000 per year. Tom's wife did not work. Tom and Dick spent all of their family income. Since they paid into Social Security, they figured they didn't need to save for retirement. Harry and his wife, on the other hand, had, over many years, put away money each month and invested it in stocks and bonds. Here's how it worked out. Tom made $25,000 a year. Dick and his wife made $75,000, and Harry and his wife $150,000. When a new housing development opened up in their community, the brothers decided to buy equally priced homes on the same private street. One day, the brothers decided to pool their funds for the purpose of improving their street. Concerned about crime and safety, and wanting a more attractive setting for their homes, the 3 families decided to install a security gate at the street's entrance, repave the street's surface, and enhance the lighting and landscaping. The work was done for a total cost of $30,000. Harry assumed they would divide the bill 3 ways, each brother paying $10,000. But Tom and Dick objected. "Why should we pay the same as you?" they said. "You make much more money than we do." Harry was puzzled. "What does that have to do with anything?" he asked. "My family makes more money because my wife and I work long hours and because we have saved some of the money we've earned to make additional money from investments. Why should we be penalized for that?" "Harry, you can work and save all you like," Tom countered. "But my wife and I want to enjoy ourselves now, not 25 years from now." "Fine, Tom, do what you want. It's a free country. But why should I have to pay for that?" "I can't believe you're being so unbrotherly," Tom argued. "You have a lot of money and I don't. I thought you'd be more generous." At this point, Dick, the peacemaker in the family, entered the conversation. "I've got an idea," Dick said. "Our combined income is $250,000, and $30,000 is 12% of that amount. Why don't we each pay that percentage of our income? Under that formula, Tom would pay $3,000, I would pay $9,000, and Harry would pay $18,000. I have a much better idea, said Tom, and one that's fairer than what you're proposing. Dick and Harry turned to Tom. Harry should pay $23,450. Dick, you should pay $6,550. And I will pay nothing. To Dick, this sounded completely arbitrary and not really fair, but it did have one big plus. His share would be $2,450 less under Tom's formula than under his own. So, he decided to be silent. Harry, however, was stunned. You want me to pay almost 80% of the bill despite the fact that each of us is receiving the exact same benefits? Where did you get such a crazy idea? From no less an authority than the U.S. government, Tom responded as he pulled out a gray booklet. It's all right here in the IRS tax tables. This is the progressive income tax system all U.S. taxpayers live under, and I don't see why we should be any different. In fact, I believe all future improvements should be paid in this way. Works for me, said Dick. So, by a vote of 2-1, the cost of the street improvements was divided as Tom had proposed, even though they benefited equally, and even though the reason Harry had more money was that he and his wife had worked many more hours than his brothers and their wives, and had saved some of what they had earned, instead of spending it all. Tom and Dick lived happily ever after with their new arrangement. Harry grumbled a lot, but whenever he complained, his brothers called him greedy and selfish. The end.
Okay, cute video there. Okay. So we're talking about a progressive tax, which means the more money you make, the higher your percentage per dollar is. Progressive tax. And you may have heard the term tax brackets. Now, this table that I'm looking at here is somewhat dated, but it still talks about, gives you that concept of progressive tax. The more you make, the higher your percentage. And also tax brackets, which means as you move up from one line, or actually in this case, you're moving down the bracket here from one line to the next. As you move down a line, your percentage goes up. So you start out here, if you're making between $0 and $16,000, your tax is 10%. Then as soon as you start making more than $16,000, the next dollar, which we call the incremental tax, the next dollar you make is taxed at 15%. If you kick up to $65,000 of income, the next dollar you make will be at 25% or 25 cents per dollar, clear up to, if you're making a lot of money, you're going to pay 35% of any money you make over, in this case, $357,000 plus change. So again, progressive tax is a key element of the Internal Revenue Service tax code. The more you make, the higher your percentage. Now, here's something you may have heard about before, a Form W-4. Now, this is a dated one here, and I want to deviate here just briefly and pull up a current version of a W-4. And those of you that are employees should have seen something like this. The W-4 is a form that you fill out on your own. You're essentially telling your employer that this is what I want to have taken out of my paycheck. And there's various elections with this. You put in your name, you put in your filing status, and then down below here, you say, how many exemptions am I going to file? And you go through this whole form here, and then you determine how many you are going to enter. So for example, down here it says, step 3, claim dependents. Step 4, other adjustments. And then down below, you sign here. Now, your employer doesn't necessarily have to check your information. You are presenting this to them from information that you have. And I'll talk about your goal here later on. But again, this W-4 is a form you fill out at the beginning of employment, telling your employer how much to take out of your check. Going back to my presentation here, which I deviated from. All right. Whoops, we did not want to go there. You know what? This is a live video. I'm not going to go back and edit. I don't have time for that. So again, the W-4 is when you are an employee and you're telling your employer how much they are to take out. And by the way, you can change your W-4 elections to your employer. I wouldn't do it too often, or else they might get a little bit frustrated with you. But they have that on file, and that's what they take money out based on the W-4 you fill out and give to them as a condition of employment. Now, the W-2 is the form you get at the end of the year called a statement of earnings that determines, you need your W-2 in order to fill out your tax return. So at the end of the year, generally it's going to be the end of the year at December 31, your calendar year, your employer has a month to calculate your earnings and taxes and give you a statement of earnings for the year on that form W-2. So the first thing we need to do with taxes is determine what's a W-4. That's before you start working. W-2 is at the end of each year, your employer gives you that statement. And I had a friend from class of 2018, the little mnemonic that she used was, the W-4 is for before you start working. And once you get your W-2, it's too late to change your information. It's too late to change your withholding. So before you start, and it's too late. Now, two things you need to understand is, one is your tax burden is, when you go through your whole calculation of this is what my income was for the year, here is all the people are dependent on my income, here are some things that maybe reduce the amount of taxes I have to pay, and at the end, you have like a tax bill, an income tax bill that you have to pay. That's your tax burden. Calculating that on your tax form, generally a Form 1040 at the end of the year. Contrast that with your tax withholding. They are the payments or the deposits you are making throughout the year, generally through your employer, through the money taken out of your paycheck. And your employer takes that out of your paycheck, and they, by law, have to send that to the Internal Revenue Service to be credited to your account to offset your tax burden. So the tax burden is your bill. The tax withholding is that money or those payments that you're making through your paycheck every month or every pay period against your tax burden. So it's important you understand that. Stupid is as stupid does. Your goal as someone filing your taxes is to match up your tax burden with your tax withholding. Again, you got to figure out from your tax burden, which you use the W-2 for at the end of the year, match that up with, hey, with my W-4, I'm estimating how much money should be taken out of my paycheck. And your goal at the end of the year is for that to zero out, to not have to pay the government any additional money, nor to have to make an additional payment to the government, or I should say get a refund back from the government for money that you over withheld. So not have to pay any money to the government, not have to receive any money in the form of a refund. What people think, they love getting big refunds. And right around April, you'll see, hey, if you're getting that big tax refund, you can put it into this new car, this new appliance, this new whatever. But that is a really poor investment that people make, and they get all excited about, hey, I'm getting a $3,000 refund. Well, they gave that money to the government in some cases. If they're filing in April of the current year, some of that money might have been taken out of their paycheck clear back in January of the previous year, and February, March, and so on. But let's take that money in January of the previous year, and I'm filing in April of the next year. That's like 15 months that my money has been sitting in the Internal Revenue Service bank account, and I've been earning zero interest on that money. So when I get my refund back, yay, I get a refund, but boo, that money didn't grow at all since the time it was taken out of my paycheck as much as 15 months ago. And this is what stupid people do. Sorry I use that term, but I think it's silly that people get excited about large refunds when they could have taken that extra money being taken out of their paycheck, adjusted their W-4 to match up with their tax burden so that their employer is taking maybe less out of their paycheck, but then being diligent and then taking that money and depositing it somewhere, maybe putting it in some sort of an investment or getting into something like a health savings account, which we talked about a while ago in our insurance unit. There's all kinds of things you can do other than sticking it in to your withholding, money being taken out of your paycheck at 0% interest. As I mentioned, state income tax right on the border. Here in Washington, we don't have a state income tax. In Oregon, there is one. Well, what happens with us like a border town, if you're curious about that? Well, if you work in Oregon and you live in Oregon, you pay state income tax. If you work in Oregon and live in Washington, you pay state income tax. If you work in Washington but live in Oregon, you pay state income tax. But if you live in Washington, like I do, and I work in Washington, then I don't pay a state income tax. And this got really interesting a couple of years ago with guys that were working on the Columbia River dams. And they were trying to report like how much of their time was spent, because the line for the states is right down the middle of the river. And they're trying to determine how much of my time is spent in Oregon and Washington, blah, blah, blah. And finally they came up with, hey, let's just split it right down the middle. And if you work on the dam, half of your income is going to go as Washington income, not subject to state income tax. The other half would go to Oregon income. State income tax. Again, in Washington, we do not have state income tax. And living near a border city can be an issue. Social Security, Medicare, self-employment. First of all, Social Security. If you are an employee working for a store or a business or whatever, 6.2% of your income is being taken out for Social Security. Now, there are some exemptions around that in special circumstances, but most people pay 6.2%, and their employer matches that amount. They pay 6.2, employer pays 6.2%. The money's taken out of your paycheck, and your employer then sends it to, in addition to the money taken out for income tax, your employer sends that to the Social Security Administration. This is for your retirement. We talked earlier in the investment unit about don't depend on Social Security. Medicare, of course, is medical coverage for retired people, and it is 1.45%, which again, your employer matches, and they send that money to Social Security. There's federal tax items. So Social Security is one, Medicare is another. Third one, of course, being federal withholding. So those are the three main items related to the federal or the United States government that are being taken out of your paycheck. However, what happens if you're self-employed? Oh my. Well, because you are both the employee and the employer, guess what? You get to pay double. You get to pay 12.4% Social Security. You get to pay 2.9% Medicare. Plus, you've got like self-employment taxes and things like that. So you have to pay federal withholding, in this case, in the form of deposits that you send money in every quarter generally. So self-employed people generally make more money per hour, though, because they have a special skill. They get paid more per hour. They have to figure out not only the tax situation, but also their medical coverage, because there's no employer that's paying their premium for like medical and dental care. So here we go. Here's an example of using a tax table. Ron Single is using an IRS tax form and calculates that his taxable income is $51,000 plus change. Instructions tell him to use the tax table to determine his taxes. How much does Ron owe in taxes? Now understand these tax tables are both in the instruction book for Form 1040, pages and pages and pages of them, plus they are online as well. You can find pages and pages of them there as well. So here we have a portion of a Internal Revenue Service tax table, and we want to make sure we look at the single column. Ron is single, so he doesn't have any dependents, nor is he married, have a legal significant other, something like that. So we go down this left side here where it says at least, again, his income is $51,482. We go as far as we can in the at least column until we go over. So $51,450 is the largest amount we can get to without going over $51,482. So we end up between $51,450 and $51,500. So we're on this row. So we determine we're on that row there that's highlighted in red. And then we slide over to the single column, and Ron's tax, or his tax burden, is going to be here as $9,213. So understanding how to read the tax tables for starters is a nice skill to know. Well, here we're going to use something called a tax schedule, which is kind of an abbreviated, shortened version of the tax tables. And the tax tables are basically based loosely on these tax schedules that look like this. All right. And it says down here, it says your taxable income is. Now, let's differentiate between your gross income or your total income, your reported income, maybe on your Form W-2. Understand there's going to be all kinds of things, such as an exemption you get just for being a taxpayer, to having dependents, to having certain activities like putting money in a 401k or putting money in a health savings account may reduce the amount of income that you have to pay on. So after you do all these different calculations, and we'll get into these in the tax forms, you start out with that gross income or that total income, and you have these adjustments and deductions to get down to, okay, this is the amount that's of my income that is subject to income tax, to determine what my tax burden is. That's taxable income. And you'll become a little bit more familiar with that when we work with and practice on some of these tax problems. So here we have Maria and Don. They made $153,900. They're filing a joint return. So here you want to make sure you went to the tax schedule for married filing jointly. And we want to make sure we come down here and find the largest amount not over $153,900. Well, that would be $131,450. So we're between $131,450 and $200,300. We're going to go over some practice problems around this here in the near future. So we're between those two numbers, and our tax bill is going to be $25,550, which is the tax. That's essentially the tax on all of the previous tax brackets above, this, and this, these three tax brackets, or $25,550 is the tax on $131,450, which I just kind of went too far there. Sorry about that. Let's go back. Technical difficulties, yes. All right. And so we're going to calculate the tax as being $25,550, which is the tax on all of those previous brackets, plus 28%. Now understand, we only have to pay 28% on the amount that is over $131,450. So it says your tax is $25,550 plus 28% of the amount over $131,450. So only a small amount of our income is actually going to be subject to that 28%. That calculation is going to look like this. Well, first of all, we determined the tax bracket, the interval being used. Again, that was 131,450 was the largest amount in that tax schedule column. Algebraic expression where X equals tax and T equals taxable income. Yes, we're getting into algebra. Oh, joy. X is our tax. We take the base tax amount, which in this case was 25,550, correct? Plus T, the taxable income, or what the schedule calls the amount over, or excuse me, T is the taxable income, and we subtract what the schedule calls the amount over times the tax rate. It's like, oh my goodness, Reardon, what are you talking about? Let's drop some numbers into there. The example for 153,900 would be X equals 25,550. Let me skip back here really quick. 25,550 with the tax on all of our previous brackets, plus our total taxable income was 153,900 minus the amount over 131,450, or the bottom end or the bottom of that tax bracket. Let's go back up and look at that again. 131,450 was the bottom part of the tax bracket. So we only have to pay again 28% on the amount that is over 131,450. We would take 153,900 minus 131,450, which, if my brain is calculating correctly, would be 22,450 times 28% as a decimal, 0.28. And I'm not going to break all that down right now. We'll have some practice problems on this. But that would come to, if you took those two numbers there, at 22,450 times 0.28, that would come out to 6,286, if my math is correct. Take your 6,286 and add it to 25,550. You come up with 31,836. That would be the tax based on the tax schedule. So again, next thing we're going to do is some practice problems around that. So there's a little warm up to talking about income taxes, talking about some terminology, and getting into both reading the tax table and understanding how a tax schedule works. And again, that key concept of progressive tax, the more you make, the higher your percentage gets. And the other concept of matching your tax burden with your tax withholding, your goal being zero, and not to give your money to the government at 0% interest for a long period of time. I hope you found that entertaining, and we will be talking soon. Take care.